This is the first in a series of resources on the roles of money, the federal government, and the Fed in the economy of the United States. Part 1 considers money, how it is defined, how it is measured, and how it is created. Part 2 looks at the money market and what creates demand for money. Part 3 inspects inflation and its cost to the economy. Part 4 considers fiscal policy, defining it and its role in stabilizing the economy. Part 5 inspects the federal budget, its components, how it is funded, and what role federal deficits play in the economy. Part 6 looks at the Fed, its role, structure, and functions in the economy. The final part of the series considers monetary policy and how all aspects of fiscal and monetary policy affect the gross domestic product. To an economist, the idea of money is a little different from a layperson. The formal definition of money is any item that is regularly used in economic transactions or exchanges. It must be accepted by both buyers and sellers. Some examples of money are obvious, like currency. However, things like cigarettes for prisoners can also be considered money. Other items that we may think of as money technically are not. We will discuss these counterexamples later. There are three properties shared by anything that is considered money. Any form of money must be a medium of exchange, a unit of account, and a store of value. Let's describe each of these properties in detail. A medium of exchange means that money changes hands when transactions occur. Money is the item that buyers give to sellers when purchasing goods or services. The opposite of this is the idea of bartering, where one good or service is provided in direct payment for another. As an example, let's look at different ways a buyer can pay for a haircut. With medium of exchange, the buyer gives some token of value as payment for a haircut. In bartering, a buyer gives 3 chickens to cover the cost of the haircut. The next feature of money is that it is a unit of account. This provides a standard unit that can be used to state prices and compare values. What would that unit of account be in the United States? While we have other denominations, pennies, nickels, dimes, and quarters, the unit we use as the unit of account is the dollar. For example, a soda costs $2, a shirt costs $28, and a used car is worth $15,000. The final required feature of money is that it is a store of value. This means that money does not lose value over time. The exception to this concept is inflation, in which prices increase as time goes on. While the three different features explain what can be defined as money, there are different types of money that exist. On the global scale, there is the distinction between commodity money and fiat money. Commodity money has its value backed by stores of some valuable material, often gold or silver. Fiat money has no official backing, and instead has value due to belief in the system that provides the money. The US dollar is an example. A dollar bill has value because the government says it has value, not because it is backed by some fraction of an ounce of gold. But how much money is there in the US economy? Well, that depends on what definition of money you want. M1 is more immediately usable, as it includes currency, demand deposits, other checkable deposits, and traveler's checks. M2 is a broader definition of money. It includes all of M1, but also includes items that are not immediately spendable, like savings deposits, small time deposits, and money market mutual funds. Whether we consider M1 or M2, the amount of money in the US economy is constantly fluctuating. Why? In short, because banks can create money. We should realize that banks are businesses. They make their profits by collecting interest on their loans. However, the banks are required by the government to have a reserve, which is some percentage of each deposit that a bank is required to hold onto, instead of loaning out. But because a bank is a business, it is reasonable to assume banks will loan out however much money they can. So how does this create money? Let's look at an example. Suppose that some company, the ABC Corporation, just received $2,000. They chose to deposit that money into the First National Bank. The going reserve ratio is 10%. We want to figure out how much money is created just from this deposit. Banks will lend out whatever funds they can. The bank is allowed to lend out 100% minus the 10% reserve ratio. Therefore, the bank will lend out 90% of whatever deposits they receive. First National Bank will lend out 90% of the $2,000 deposit, or $1,800. Let's say the recipient of that loan is the DEF Corporation. The DEF Corporation then deposits that $1,800 into the Second National Bank. Second National Bank then lends out 90% of that $1,800, or $1,620, to the GHI Corporation. GHI Corp deposits that amount into the Third National Bank, who lends 90% of that $1,620, or $1,458, to JKL Corp. And the process continues. The total increase in money is found by multiplying the amount of the initial deposit by 1 over the reserve ratio. So for an initial deposit of $2,000 with a 10% reserve ratio, the total amount of money increase is $2,000 multiplied by 1 over 0.10, or $20,000. Of course, the same thing works in reverse if companies take their money out of the bank.